Welcome to Hardly. The book is distilled into 3 stories, giving you the key ideas in minutes. Today, we listen to Philip A. Fisher's Common Stocks and Uncommon Profits and Other Writings, in which we probe into how to identify companies with long-term growth potential, the significance of scuttlebutt in making informed investments, why patience and long-term thinking trump market timing. Philip A. Fisher, an American investor, founded the investment advisory firm Fisher & Company in 1931. Don't go away. Hurdley, the editor, will be right back with the story. Today, we'll journey through 3 insightful stories from the book that highlight the importance of identifying long-term growth potential, the value of using scuttlebutt to gather information, and the rewards of patience in investing. In the early 1950s, Fisher had his eye on Motorola, a company that had emerged as a leader in the radio business. At the time, Motorola was transitioning into the television industry, which was a risky but potentially high-growth market. Fisher didn't just rely on numbers and financial reports to assess Motorola's potential. He spoke directly with the people on the ground: customers, competitors, suppliers, and even employees. This approach, known as scuttlebutt, gave him a complete picture of the company's strengths and weaknesses. The competitors respected Motorola for its innovative products, and customers were impressed by the company's commitment to quality. His research suggested that Motorola wasn't just riding a short-term trend, but was laying the foundation for sustainable, long-term growth. The lesson here? The deeper insights you gain from people connected to a business can help you spot real growth potential. While financial reports can be manipulated, the word from those who work with or against the company can't be faked. Fisher believed the 15 points are about very fundamental business features that can't be faked. The key is to identify a company with future growth potential and a strong foundation, something that traditional analysis might overlook. This leads us to the second story, where Fisher applied the same scuttlebutt method to Raychem, a smaller company in the specialty chemicals industry. Raychem was innovative, focusing on niche markets with unique applications. However, it wasn't a well-known firm, and traditional investors ignored it because it lacked flashy numbers or widespread popularity. Fisher, using his network of contacts, spoke with engineers and competitors in the field. These professionals acknowledged Raychem's technological edge and respected its research efforts, even though the company was not making headlines. The engineers saw the long-term potential, despite the company's low profile in the stock market at the time. By trusting his sources and not being swayed by public perception, Fisher invested in Raychem early and reaped massive returns over the following decades. His experience with Raychem reinforces the value of understanding a company's position in its niche market. You don't always need to bet on the giants of an industry. Sometimes, the most innovative companies are found in unexpected places. The key takeaway? Be willing to dig deeper and go against the crowd when you discover true innovation backed by industry respect. Our final story comes from Fisher's dealings with Texas Instruments. During the late 1960s, Texas Instruments was rapidly becoming a dominant force in the semiconductor industry. The company had great potential, but the stock price was volatile due to market fears and speculation about the industry's future. Many investors got caught up in the market timing frenzy, trying to predict the best moment to buy or sell. Fisher, however, took a different approach. He focused on the company's long-term ability to innovate and maintain profitability. He knew that Texas Instruments' research capabilities and management were second to none, which would ensure its ability to stay ahead in a highly competitive field. Instead of being swayed by short-term market fluctuations, he held his position and waited. This strategy proved immensely successful. While other investors jumped in and out of the stock, Fisher's patience paid off as Texas Instruments continued to grow and reward long-term shareholders. His decision not to sell during downturns was a testament to his belief that if you figure out the right things to buy, selling becomes a lot less important. By maintaining focus on the company's fundamentals rather than market timing, he was able to ride through the volatility and secure significant returns. As we move from Motorola to Raychem and finally to Texas Instruments, the common thread is Fisher's reliance on deep research and patience. Whether speaking to insiders in the industry or resisting the temptation to time the market, each of these stories demonstrates that the most successful investors are those who look beyond the surface. They trust the facts and the long-term potential of a company, regardless of short-term market noise. By consistently applying his methods of thorough research, Fisher was able to identify companies that could thrive over decades. What can we take from these stories? For one, never underestimate the value of scuttlebutt, real, on-the-ground information that's often more revealing than any financial report. Additionally, patience remains one of the greatest virtues in investing. Holding onto a solid company for the long haul, even through market volatility, often leads to far greater rewards than trying to time your entry and exit. As the editor of Hardly, I believe that by studying these methods, we can move beyond short-term thinking and start focusing on the long-term growth of our investments in a way that others may not yet see. This future-oriented approach can allow us to cultivate unique insights and make more informed decisions. Each story comes from the most representative real-life cases selected by the Hardly team from this book. Besides these three, there are at least 15 more worth reading that delve into valuable investment strategies. If you wish to dive deeper, we recommend purchasing the full book. Finally, share a sentence from the book to end today's reading. The stock market is filled with individuals who know the price of everything, but the value of nothing. In reflecting on the key points from this book, Fisher's wisdom truly shines in how he approached long-term growth, the power of scuttlebutt, and the importance of patience. Let's wrap things up with one more compelling story. Fisher's investment in Nucor, a then small steel company, is an excellent example of how his principles came together. Nucor was not a glamorous firm. It produced steel at a lower cost than its competitors by using innovative methods. While the broader market ignored the stock, Fisher dug deeper, using scuttlebutt to speak with industry insiders. Competitors quietly acknowledged Nucor's efficiency and ability to undercut larger firms. Customers appreciated the consistency and price of their product. Despite being in a highly cyclical industry, Fisher recognized the firm's strong management and low-cost production model as long-term strengths. He invested and held the stock for decades, watching it grow from a small player into one of the largest steel producers in the U.S. This story encapsulates Fisher's investment philosophy, finding companies with real potential, confirmed through rigorous research, and patiently holding them for the long haul. His approach allows investors to rise above short-term market volatility and focus on the fundamental strengths that drive sustainable success. By learning these lessons, we can approach our investments with clearer eyes and a longer-term view, guided by principles rather than market noise.